Hey guys, welcome to another webinar with Bay Equity Home Loans. This time we are pleased to have Teresa Carter with us. Teresa is the MGIC rep, that's mortgage insurance, which she's going to tell you all about. She is a rep for a number of states, and I'm going to let her tell you. I know it's Arizona and Hawaii and California because I do loans in those states. And she's great. We've got to know each other recently, and she knows all about mortgage insurance. Teresa, thanks for joining us. We appreciate that.
Thank you so much for having me. I'm Teresa Carter, as you said, account rep with MGIC. I cover states California, Arizona, Nevada, New Mexico, and Hawaii. And I am ecstatic to talk to you today about one of my favorite topics, mortgage insurance.
Okay, we have to ask the question, why are you so excited about talking about mortgage insurance, Teresa?
Because mortgage insurance helps millions of people get into homes sooner. How can you not be excited about that?
Absolutely. I guess that's the end of our webinar. I mean, that says it all right there.
That's it. That's it.
I think Teresa has a PowerPoint presentation, and she's going to be a little bit more strategic and tell us all about how mortgage insurance gets millions of people into houses earlier. Absolutely.
Absolutely.
Why
So,
don't you share your screen with us, Teresa, and we'll ask you questions as you're telling us what we need to know about mortgage insurance.
okay. So I'm trying to share, and it looks like you have to allow that. So it says only meeting organizers and presenters can share.
Let's see if I can do that. Oh, yeah, you're an attendee. I can fix that.
Okay.
Okay. You can do it now.
Okay, so let's get started. You let me in. Yay.
Here we go.
All right. Basics of mortgage insurance. We are opening the door for millions of families. Now, before I get started, I'm supposed to let you know that the legal team wants to share this very brief message. Essentially, it states that any opinion I may give are mine and not necessarily that of MGIC. The information is general information, and the examples are hypothetical and for illustrative purposes. So now let's talk about the fun world of mortgage insurance. What is mortgage insurance? Mortgage insurance, whether it's private or backed by the government, is insurance designed to protect the lender or investor against borrower defaults. So to the lender, mortgage insurance is a financial guarantee that reduces the risk of exposure in the event that a borrower is unable to repay their loan. With MI, the lender or the investor, they won't suffer a complete loss, but share the loss with the mortgage insurer. And there are some amazing advantages to mortgage insurance. So let's take a look. For loan officers, mortgage insurance not only provides lenders and investors with the ability to protect their investment by structuring safe, high LTV loans, but it increases loan officers' customer base by helping more borrowers qualify without requiring them to put 20% down, which is huge. It means you get to better serve your community by creating more homeowners. So for you as a loan officer, it's a tool to do more loans, engage your referral partners, and help more people become home buyers.
Absolutely. Up for that.
Amazing. For real estate agents, MI can be used as a tool to do more loans, engage your referral partners, and help more people become homeowners. Do you see a theme here? It's just like more, more, more. And for borrowers, let's talk about it. Look, skyrocketing home prices combined with record low housing supply have made home ownership seem unreachable. But it's critical that affordable, sustainable, low down payment mortgages are available to meet our borrowers' needs. Private MI helps
Absolutely.
borrowers. It helps them. What does it do? You get to buy sooner. You get to buy more. You get to keep more cash in your savings account, and it expands your financing options. Do you see a theme here? More, more, more. Mortgage insurance means more.
With a less down payment, though, we picked up on that too.
Yes, with less down payment. So let's look at an example. Say your borrower saved up $25,000 for a down payment. Instead of making 20% down payment on a $125,000 property, good luck finding that, right?
Yeah.
That borrower may want to put 10% down on a $250,000 home. That with that same $25,000 down payment, they get a $250,000 home. Or they may want to put 5% down on a $500,000 property. Look at how far $25,000 can get you with mortgage insurance. Or maybe they find a $400,000 property. They put 5% down. That's a $20,000 down payment and $5,000 left in savings. So we get more house and more money in savings. See where I'm going
We
with
like
this?
it. Yeah.
Yes. So look, whether they're new or established homeowners, they're going to spend about $13,000 on average in improvements and maintenance on a home. New homeowners often need or want to purchase appliances, furnishings, any kind of touches, basically, that make a house their home. MI gives you more money to do that. Let's talk about who uses MI. Since 1957, 37 million homeowners have used MI.
Wow.
Yeah. More than 2 million individuals alone in 2021. 69% of first-time home buyers. Look, it's no secret we're in a purchase market right now. First-time home buyers are a huge part of a purchase market. 69% put less than 20% down. 68% of millennials want to put less than 20% down. And let's be honest, it takes a long time to save 20%. In the great
Yes.
state of California, 28 years to save 20%.
And imagine what real estate did over that same time period in terms of appreciation, right?
Exactly, exactly. So these are the top states that use private mortgage insurance based on 2021. New numbers are not out yet. So you see Texas, the great state of California, Florida, Illinois, and Ohio. So any questions now that you know how much more you can get with mortgage insurance? Any questions?
We get the more theme here, Teresa. You've done very well with that. This is just kind of interesting to me, these states. Is there a particular reason why Texas and California and Florida are leading the way by so many more?
You know, that's a good question. And I'm not sure why what the reason is, but I will say Texas, California, I mean, those are heavily populated areas, right?
Yeah, yeah,
So
they
it
are. They
could
probably
just
have just a
be,
bunch more home buyers, don't they?
yeah, it could just be really a higher population.
Yeah. Okay, so good. You're catching my next question. How does MI work? I mean, we gotta get it insured, but maybe you can explain that, the intricacies of that to us. That's perfect.
Now, John, I thought you'd ask me that, and that's why I am ready. So
You
now
are.
that
You're
we've
on it.
looked, yeah, now that we looked at how MI can help you and your borrowers, let's take a closer look at how MI works. Let's see. Okay, so let's talk about coverage levels. Lenders select mortgage insurance coverage based on the borrower's down payment and the LTV level, with the most common coverage amounts set by Fannie and Freddie, of course, as we see here. Anything over 95% to 97% requires 35% coverage. Anything over 90% to 95% requires 30% coverage. Over 85% to 90% requires 25% coverage. And then anything over 80 to 85% requires 12% coverage. So let's look at an example. We're looking at 25% coverage here. The loan goes into default with a remaining balance of $180,000. Once you add in the delinquent interest, the fees, cost, and other expenses, we have a total claim of $199,000, right? So with the percentage option, MGIC pays the lender that 25% of the calculated loss, equaling $49,750, and then the lender sells the property, so hopefully recouping their loss, right? With the
Got it.
acquisition option, MGI pays the lender the entire calculated loss of $199,000, and then MGIC buys the property and sells it and recoups their loss.
I didn't know that that worked that way, that MGIC had that option.
Yes.
Is it your option, the MGIC's option, which one they want to do, or is it the lender's choice?
I believe it's the lender's, it's going to be the lender's option.
Okay.
But these are the most common, most popular options. And most of the time, I do believe the lender will do the percentage option, right?
Okay.
Because they're only taking a loss on a certain percentage. They're going to sell, they're going to recoup. Now,
Yes.
let's talk about one of my favorites, MGIC premium payment options. So you've noticed the theme that you get more and more and more with mortgage insurance, but you also have these options, more options, okay? We have borrower paid monthly MI premiums, borrower paid single premiums, borrower paid choice monthly premiums, borrower paid split premiums, and then lender paid mortgage insurance single premiums. So let's dig into this. The most popular and easily understood premium plan is borrower paid monthly MI. It's simple, it's easy, and it's probably the easiest to explain to your borrower. There's no upfront premium. It's paid with a monthly mortgage payment. It's very versatile, and it can be canceled, which is amazing. Single premium or borrower paid MI, BPMI, can be paid all at once in one lump sum. They can be structured in one of two ways, either paid by the borrower or paid by the lender. But with borrower paid single premiums, borrowers have the option of paying the MI premium in one lump sum at closing, or depending on investor guidelines, this can be financed into the loan, okay? So it's essentially an upfront premium paid by the borrower, seller, builder, or third party, can be financed into the loan, and a portion of that can be refundable when canceled.
And Teresa, when you have different options of people who can pay, do they occasionally split the cost of it? Does that ever happen?
That's a good question. I think most commonly, single premiums are just paid by the borrower upfront,
Okay.
right? There are times when a seller gives a credit or, those things go into effect, but most commonly it's just paid upfront by the borrower.
Do you know for sure whether it could be split? Like that could be a really good solution if each of those four parties could pay 25% of it. It wouldn't be a big hit for any one of them.
Yeah, that's a good question. And I will ask about it. I'll find out for you. I'm pretty sure it can be split. I think that it probably has a lot to do with how that's stated or worded, right?
Right.
Borrower credits are allowed. Seller credits are obviously allowed. So, I mean, lender credits, seller credits, and then the borrower pays the premium. So if each is doing 25%, of that amount, I think it could work where everybody's paying a little bit of a single premium.
Yeah, might work out. You'll have to let us know. But
I'll get some more details on that for you. Look at you stumping me already.
Oh, not so much. It's probably an odd question. I get it.
So choice monthly, this is amazing because this is MGIC's newest premium option. The plan gives your borrower the option of paying part of the MI premium up front to reduce the monthly MI premium amount. So this is amazing because it's customizable up front. If your borrower says, look, I only have, I don't know, $3,000 that I can put up front for MI, this is a great option because you can plug that number in. It'll tell you what the monthly payment will be, and you can go from there. So your borrower gets to customize what they want to put up front. Very similar to a split premium, but it's customizable. And
Okay.
the upfront option can be financed into the loan. It can be a lender credit. It can be a seller credit. It lowers the DTI ratio for the qualifying loan, and it stays within the 3% QM rule. So this is a great brand new option currently available at MGIC, and not all of our competitors have it. So keep that in mind. We're the best.
Before you move from that slide, can you explain to the uninitiated what the 3% QM rule is, please, Teresa?
I knew that you were going to ask me that.
I am not going to ask you that.
And it is complicated. Let me see. I had an entire slide for myself about the 3% QM rule, John, because it is not something that I deal with every day.
Yeah. We can just kind of give an overview of that, Teresa, if you want, and just let people know. A QM is a qualified mortgage, guys, and qualified mortgages are mortgages that are set by the CFPB, which is the financing bureau that was established back in Dodd-Frank era. And it says you cannot pay too much as a borrower for a loan.
Right.
And so all of the fees that go into it, including MI, get thrown into that. And when you get paid too much, it violates the rule and we have to drop the fee someplace. That's basically it. Teresa, would you agree?
That is basically it. A loan has to meet several standards to be, considered a qualified mortgage. And you have to avoid basically risky loan features, such as, negative amortization or a term longer than 30 years, balloon or interest only payment, or fees that exceed 3% of the full loan amount. Any fees that exceed that 3%, it's basically considered a risky loan feature, right? And so that's why they have this rule. So this Choice Monthly is an amazing premium option because the fees stay within that 3% QM rule.
Very good.
Yes, avoiding making that loan a risky loan feature.
Which means the lender won't do it if it gets too risky, guys. That's the significance of that.
Yes, perfect. So let's see. Choice Monthly, great option. Only available at MGIC.
And that's good to know.
Throw that in there. LPMI single premiums. So the other method of paying a single premium is lender paid. As the name suggests, lender paid mortgage insurance, commonly known as LPMI, is paid for by the lender. However, to cover the cost of the premium, the lender will often increase the loan fees or commonly the interest rate. So right now, this is not a very popular option because interest rates are a little bit higher already.
There you go.
So lenders don't want to make it any higher for their borrowers. Okay, so let's take a look at an example. Now, it takes years for a household earning the national median income to save 20%. That time drops to just a few years when you use mortgage insurance. More house sooner. So you can also use MI to make your client's offer stand out. So if we look at this example, say the borrower has saved up $150,000. They have a $750,000 purchase price, right? For 80% LTV, they'll pay that $150,000 down. Loan amount will be $600,000. Principal and interest looks like $3,597. Done deal. But if we make this an 85% LTV loan and use MGIC mortgage insurance, your borrower can put a down payment of just $112,500. That means that they get to save $37,500 in their bank account. That's huge. More money in their bank account. Loan amount $637,500, and their principal and interest payment $3,822. So they save $37,500, and the difference in payment is about $283. And in 3 years, they can get rid of that mortgage insurance. 3 short years. Huge. That's for monthly MI. We also talked about the options of single premium or single finance. Either way, with the 85% LTV, they're going to save $37,500. I can't say enough. $37,500.
It's a lot of money.
Yes.
Yes.
And their payment will go up about $200, $225 for a single MI. And again, they can cancel that MI in about 3 years. So that means that payment's going to go right back down without them having to refinance the loan.
That's
And they
amazing.
got to keep $37,500.
Yeah. And I just
It's
got to embellish on this for what Teresa's saying, guys, because if you don't have that 150,000 and you have 112 and you're going to save up and it's going to take years, a year or 2 or 3, that $750,000 house national average is going to go up by 4 to 5%. Let's say 5, because it's easy for me to calculate. That's $30-some thousand increase in the price of the home 1 year from now while you're trying to catch up with that with your savings. It's almost impossible for people to try to catch up with reasonable house appreciation in their area by saving for a larger down payment. And you could have had that appreciation go onto your balance sheet. If you were to purchase it earlier with that 112,000, you would have more house,
yes.
as Teresa would say, earlier. So true. Now, Teresa, I got to ask you though, getting rid of the mortgage insurance in 3 years is what you said?
Yes, in this scenario, in about 37 months, which is
That's
about
pretty amazing. What is the calculation? How do people get rid of MI? Maybe you're going to cover that later. And if you want
I
to,
am going to cover that, John.
All right, sounds good.
Yeah, we're going to get to that. But since we're on this, I want to also say MI can also be used as a strategy to compete right now, in this mortgage market where people are offering, the price might be 750,000, right? And they may get several offers. Well, let's look at this. You can also use MI to increase the purchase price. So you can improve your offer to compete. So if we take this $750,000 purchase price, the borrower has a down payment of $150,000. He can increase his offer to $800,000, do an 85% LTV loan with MGIC, of course, and then his down payment would go to $120,000. So MI helped the borrower save $30,000 in his bank account and compete by offering a higher purchase price. So that's just one example. Yeah, how you can use MI as a strategy.
Teresa, are you by chance going to also talk about the strategy if the appraisal comes in low, how MI can help out there?
Well, I wasn't planning to talk about that because right now the appraisals aren't coming in low.
It could happen, especially when you have guys. Another little strategy with MI, and I'll just pop it in here, and Teresa, you can comment on it. Yeah. If you are buying that $750,000 house and you have the 10, 15, 20% down payment down, but it's a bidding offer or bidding war, and the house, you bid it up to 800,000, but the appraisal only comes in at 775,000, there's $25,000 that needs to get made up. And the way we typically do that, when someone has a down payment enough to cover, let's say, 10% of that lower appraised value, we'll increase the loan amount from maybe 85% of the purchase price to 90% of the appraised value. I don't want to confuse you here, but it allows you with the same down payment, we just increase the loan to be able to buy that house. It's called appraisal gap, and it's really a consideration with real estate agents when you're in the bidding war on the house. So if I confused you with that, give me a call. I'll be happy to explain a little bit more, but MI can help you out.
MI can help you. You're absolutely right, John. Here's the thing. MI can be, it's more than just a tool. It's really a strategy. And like you said, right now we're not seeing a lot of, low appraisals coming in, but the market is changing every day. It can happen. And MI is a great tool, to get past that. So now,
yeah, and even in this market, and we're in the Seattle and Hawaii markets predominantly, in Arizona, we are seeing bidding wars. And so I'm concerned that we're going to continue to see that trend happening because there's not a lot of inventory and there's pent up demand. People want to buy houses, and those bidding wars can bid up the purchase price of the house so that it may be difficult for the appraiser to bring it in. And it's nice to know that you have a plan around that if that's the case, guys.
Absolutely. Absolutely. So now, we've talked about how MI can provide more for loan officers, more for your borrowers, and even more for your real estate agents. We've also talked about the mini payment options. So you get more and you have options. You know what? It reminds me of that old song, more, more, more. How do you like it? How do you like it? That's what you get. Or even the Burger King commercial, your way, right away, here at MGIC.
I love it, Teresa. You are on it. We get more entertainment with Teresa giving us this than we even anticipated.
So now let's look at private MI compared to FHA, right?
Good question.
FHA plays a vital role in our industry, and like private MI, it helps a lot of people get into homes. So there are some similarities and there are some differences. Private MI allows for less down. However, FHA accepts lower credit scores, as you can see here with my example. Look, private MI on a 97% LTV, the lowest credit score we accept is 620. FHA, the max LTV is 96.5%. There is no minimum credit score, right? But upfront premium, there's none required with monthly MI. With FHA, 1.75%. Choice monthly, that option we talked about, the upfront premium is customizable. You put down what you want. Still with FHA, 1.75%. Do you see a lack of options there? And the monthly premium, of course, that varies based on the credit score. With FHA, you're going to do 0.50% for LTV greater than 95% and 0.55% for LTV less than 95%. But here's the biggest difference, the most important difference, the one that I want you to keep in your head. Private MI can be canceled. With FHA, you're going to be paying forever, okay? It's not cancelable at all if it's greater than 90% LTV, which most are. And
Sure.
It would take a whole 11 years if it's less than 90% LTV.
Yep, absolutely true.
Yes, so let's compare and consider. On a $300,000 purchase, down payment with FHA, $10,500. MGIC monthly mortgage insurance, 3% down, that's $9,000 down payment. Upfront MI, $5,066 with FHA. Nothing from your good friends at MGIC. Total loan amount, $294,566. And with MGIC, that's $291,000. And then your payment. Okay, monthly MI with FHA, $132. You're going to be a little higher with MGIC at $146, but your payment still comes out lower. We've got $1,994 compared to $1,985. So it looks like MGIC is a pretty darn good option, doesn't it?
Well, and it is, and it really comes down to credit score, guys. If you have a higher credit score, it almost always makes sense to take the MGIC option. If your score is low, it almost always makes sense to take FHA, and that's where the dividing line is.
Very, very true. So what he's saying to you guys, let me break it down for him. Only take FHA if you have to. Right?
Well, we're going to show your options. I assure you, we're going to compare FHA with private mortgage insurance and conventional, and you're going to choose. And it makes it it's very clear when you see the numbers.
Absolutely. So now let's talk cancellation, because you brought it up and it's quite important, right?
Okay.
So first I want to say it's the investor who ultimately decides when MI is canceled. Look, mortgage insurance companies do not require your borrowers to have MI for any certain amount of time. Not at all. We are going to cancel MI whenever that investor tells us it's time to cancel the MI. Okay? So the investor ultimately must tell the mortgage insurance to cancel. However, the Homeowners Protection Act of 1998 established rules for automatic termination of private mortgage insurance when the borrowers reach 22% equity in their home based on the original property value, as long as mortgage payments are current. And let me say that again. Mortgage payments have to be current, okay? But borrowers may also request cancellation of mortgage insurance when they reach 20% equity in the home based on the original property value. However, the mortgage payments, again, need to be current, okay?
Important
Now,
thing.
important thing. Now, while the HPA does not address MI cancellation year using current value, many investors look at the new appraised value, and with the market showing signs of appreciation, they will cancel your MI. So this is another possible option for your borrower. I have seen this a lot lately.
Good to know.
Yes. Now let's talk about MI cancellation as a business development tool. Loan officers, MI cancellation can be used as a business development tool. Home prices have appreciated a lot in the last few years. So I know you have borrowers who have purchased homes in the last 2 to 3 years, right? You want to reach out to those borrowers, anybody who's closed a loan with MI, and talk to them about canceling MI. Encourage them to talk to their lender, right? This is a great opportunity for you to connect with your past clients, help them save money, and get referrals.
Very good.
Absolutely. Now, today, we covered the basics of MI. We covered how it works, the advantages to the loan officers, the borrowers, the real estate agents. We've even covered solutions, right, for the appraisal gap, for the bidding wars, but MI is so much more than a tool. So we do have an entire website just for you guys dedicated to MI as a strategy. So please go to rethinkmi.com, take a look at the strategies, call me, call John if you need some assistance, because he seems to know a lot of strategies, okay?
Between Teresa and I, we got it covered. We have
Yes.
more strategies than your average couple of people, okay?
More.
More and more.
So, John, thank you so much for taking the time to invite me and listen to me talk about my favorite subject. You know, and you aren't so bad yourself. You want to sell some mortgage insurance?
I think you're doing a fine job. I just want to use your mortgage insurance, Teresa. How's that?
That works. I love it. I love it. Thank you.
All right. Teresa, why don't you unshare your screen, please?
Perfect.
And we want to thank you for taking time out of your very busy day, because I know you are busy, to share with us more information about mortgage insurance. I thought the M part of MGIC was mortgage, but now I know it's simply more.
More. Thank you for letting me share more.
Yeah, you did great. Thanks, Teresa. Now, if someone wants to if they do have questions on mortgage insurance specifically, you can certainly give me a call, guys, and I give our contact people or MGIC a call or whichever. But Teresa, can they call somebody directly at MGIC? Can I get a hold of you, for instance?
You absolutely can. You can call me or text me, 916-223-8131. That's 916-223-8131. Or you can shoot me an email at Teresa_Carter, Teresa_CARTER @MGIC.com.
Perfect. And guys, we're going to put Teresa's contact information on the screen. Mine will be there someplace. If you have any questions at all about mortgages, about mortgage insurance, about whether you should buy a home, about where the rates are going to go up or down, what's good strategy for mortgage insurance. As you can tell, we like to talk about this stuff. It's kind of fun. That's why we do it. Okay. And we're happy to share and happy to answer any questions that you might have. Right, Teresa?
Absolutely.
All right. Thank you once again for your time, Teresa. We appreciate it. We're going to have you back on sometime. You're a ray of great light in the mortgage insurance industry. We thank you.
Thanks, John. I'd love to be back. Have a good day.
All right. Bye-bye.
Bye.